Elasticity of demand or supply is a measure of how flexible the firm is with respect to responding to the needs of the consumer. This is not correct. Elasticity of demand or supply is a measure of how sensitive, how responsive the demand or supply is to a given change in its price. Not about how firms are able enough to respond to the changing in needs, how flexible the demand or supply is when preferences change, just price. A measure of how sensitive, how responsive the demand for a supply of a product is to change in its price. That is the correct option. Which of the following characteristics would indicate that an item sold would have a high price elasticity of demand? The item has many similar substitutes. This is absolutely right. When an item has many similar substitutes, its price elasticity of demand would be higher. Means if the price of this item goes up, since there are many similar substitutes, so people will switch their demand for the substitute. The cost of the item is low compared to the total budget of the purchaser. In that case, since it's a very small amount, so any increase in price of this particular item, the price elasticity demand tend to be low, not high. That's why A still is the good answer. The item is considered a necessity. Remember, for necessities, the price elasticity of demand is less than 1. D. Changes in the price of the item are regulated by the government agencies. This is again incorrect, because if the prices are controlled by the government, then it will be less price elastic, because the prices are regulated by the government. So that would make option A to be the correct one. Which statement is true with respect to price elasticity of demand? The shorter the time period, the more product demand becomes elastic because less choices are available. That's incorrect. If you simply replace elastic with inelastic, then this would be the correct option. Remember, the longer the period, the time period, the more product demand becomes elastic because more choices are available. So this is incorrect option. What about B? Product demand is more elastic when fewer substitutes are available. Again wrong. Product demand is more elastic when more substitutes are available, not fewer. Wrong. C. Product demand is more inelastic when more substitutes are available. Again incorrect. Product demand is more inelastic when few substitutes are available, not more. Then it has to be D. Product demand is more elastic when more substitutes are available. Absolutely right. Look no further. When there are many substitutes, then the demand elasticity would be higher. Where there are less substitutes, then the demand elasticity is lower. The basic determinant of the elasticity of demand for a normal good is the length of time producers have to respond to the market changes. This is incorrect. That would be the input to the price elasticity of supply, not demand. The number of substitutes available for the product. This is absolutely right. It's absolutely right. B is the correct option. More substitutes, more product would be price elastic. Number of sellers of the product, again that is the feature of supply, not demand. The number of complements available for the product. This is again incorrect. Complement goods are goods that are jointly demanded, like bread and butter, fuel and car, right? So number of complements available for the product. So this is totally irrelevant when calculating the elasticity of demand. Product demand becomes more elastic the greater the number of substitute products are available. This is true. This is what we have been discussing in the last couple of questions. Greater consumer income. No, consumer income doesn't affect the demand elasticity. Greater the supply, elastic supply, totally incorrect. Elastic supply is unrelated. Shorter the time period is considered wrong. Product demand is more elastic the longer the time period, because during that long period of time, more choices would become available. In the pharmaceutical industry, where a diabetic must have insulin no matter what the cost and where there is no substitute, the diabetic demand curve is best described as this. No matter what the price is, he need his insulins daily, 30. That's for the month. No matter if the price goes up, he will have to buy. So this is perfectly elastic. Look no further. This is your right option. During a period of high inflation, which of the following groups in society would be most likely to gain? Those with a fixed income, those who get fixed amount of money. When the prices go up, when there is high inflation, they will suffer. A person who just gets $1,000 every month, when the inflation is high, the rate of inflation is high, he would suffer. B is incorrect. Those with a fixed amount of debt. I have to pay $1,000 maybe in 1 year, and the high inflation means the money is losing its value. So which means this $1,000 will be a very little liability payable after 1 year for me, as the money is losing its value. So this $1,000 would be, or would appear to be, a very manageable debt for me. So those with fixed amount of debt will benefit in high inflation. Those who get fixed amount of income, they will suffer. Those holding large amount of money, the money will lose value, so they will suffer. They will suffer. Workers under contract without a cost of living adjustment. Now, if you get fixed wage with no adjustment for cost of living, no adjustment for inflation, then you will suffer. You will have less purchasing power, less earning power. So we got our answer. B is the right option. Which of the following statements regarding inflation is correct? Demand pull inflation can be caused by tax increases. This is incorrect. When the tax rate is increased, that would mean people will have less disposable income. And when they have less disposable income, they will demand less of the quantities, and thereby there will be less demand pull inflation. So this is wrong. B. Cost push inflation can be caused by decrease in nominal wages. This is wrong, because when the nominal wages decrease, your cost of production decreases. When the cost of production decreases, how can you have cost push inflation? Cost would be lower. This is incorrect. In fact, cost push inflation can be caused by high or increase in the nominal wages. So this is incorrect. Individuals holding monetary assets will be at disadvantage during periods of inflation. Let's say you have some assets worth $10,000, and since the money is losing its value, inflation means money loses its value, purchasing power. So these assets will have low value in the future. This is correct option. Individuals holding monetary assets will be at a disadvantage during periods of inflation. Companies and individuals with fixed interest debt will be at a disadvantage during the period of inflation. This is wrong. They will be at an advantage. We just saw a little while ago in the previous question, if you hold a debt you need to pay and there is high inflation, it will be easier for you to pay the debt off because the money is losing its value. So the liability becomes manageable for you. In the long run, in a competitive market, a maximum or a ceiling price set below the equilibrium. Now let me first draw it up here. Demand curve, supply curve. This is the market equilibrium price, and this is the market equilibrium quantity. The question says a maximum or ceiling price set below the equilibrium price right here. Now, since you can see that at this price level, the quantity demanded is more than the quantity supplied. So when the demand is more than supply, this would cause what you call shortage. Cause a shortage to be created. See, and in case if the minimum price is set, remember the maximum price is set below the equilibrium and minimum price is set above the equilibrium. So if there is a maximum price, this will cause shortage. If there is a minimum price, at this price the quantity supplied is more and quantity demanded is less. So when the supplied quantity is less than the quantity demanded, it will cause surplus. All of the following are complementary goods except VCR and video cassettes. They go side by side, they are jointly demanded, so they are complementary goods. Cameras and rolls of film, complementary. Gas and motor oil, they are of course complementary because they need together to run the car. Margarine and butter, they are substitutes. Either you have to have this or this, not together. So they are the substitutes. So these two items are not complementary, rest of them are. Which of the following economic terms describe a general decline in price of goods and services? That is deflation. C. Expansion is incorrect because expansion depicts one of the phases of business cycle. Inflation is the persistent increase in general price level over a period of time, and recession again is a part of business cycle. Which of the following statement is true, assuming that the demand of a product is price inelastic? PED is less than 1. Let us see each of these options one by one. An increase in price will result in decrease in total revenue. Wrong. When the price increases, the total revenue goes up. So this option is incorrect. An increase in price will result in an increase in the quantity demanded. That is more than the increase in price. This statement is incorrect as well, because when the price increases, the quantity demanded will fall, but less proportionately. Because that's what the feature of inelastic demand. When the price elasticity demand is less than 1, increase in price will cause less proportionate decrease in the quantity demanded. So this would make this statement incorrect. What about C? An increase in price will result in an increase in total revenue, and this is what we just discussed a little while ago. So that makes C to be the correct option. Let's see 1 or D. An increase in price will have no effect on total revenue. Ridiculous. Which of the following statement is true, assuming that demand for a product is price elastic? If the demand is price elastic, that would mean if the price is increased, the quantity demanded decreases and the total revenue will fall. If the price is decreased, the quantity demanded increases, the total revenue would increase. Right? Now let's see. An increase in price will result in decline in quantity demanded and decline in total revenue. Look no further. This is your correct option. The demand curve for a product reflects which of the following? This is the demand curve. What does it reflect? The impact of prices on the amount of product offered. Wrong. That would be the supply curve. The willingness of producers to offer a product at alternative prices. Again, it's supply. The impact that the price has on the amount of the products purchased. Absolutely right. When the price go up, the quantity demanded falls, and this is exactly what this curve shows, and this is exactly what this option tells you. The impact that price has on the amount of a product purchased. This is a good one. Which of the following statements about supply and demand is true? A. If supply increases, let's consider these. This is the demand curve and this is the supply curve. And let us check these options one by one. Okay. So this would be the equilibrium quantity and this would be the equilibrium price, right? Now, if the supply increases and the demand remains constant, equilibrium price will rise. Wrong. Equilibrium price will fall, as you can see. If the demand increases and supply increases, equilibrium price, it says if the demand increases, which it is now, D1, and if the supply increases, this is the new supply curve, S1, equilibrium quantity will fall. Wrong. Equilibrium quantity is going to increase. New equilibrium will be established at Q1. So this is incorrect as well. Now, if the demand increases, D1, and supply decreases, equilibrium price will increase. Absolutely. This is it. Equilibrium price will increase. This is the absolute correct option. Now, let's try the last one. If the demand increases, which is now, this is the new demand curve, D1, and supply remains constant, equilibrium price will fall. Wrong. Equilibrium price will increase. So this is incorrect as well. So it is always advisable to draw the curves and then you can see what would be the effect on the price and quantities. During which of the following periods will prices generally increase the fastest? Deflation. Wrong. Deflation is when the prices fall over time. Wrong. Recession. Wrong. Recession basically when there are two consecutive quarters, Q1, Q2, or Q2, Q3, or Q3, Q4, or Q4 of the previous year and Q1 of the current year. Two consecutive quarters see negative economic growth. That's what you call recession. And this is not what we're looking for. Inflation, on the other hand, is an increase in prices over a period of time. What hyperinflation occurs when there is a very steep increase in price levels. So that makes D to be the correct option. Okay, next. An increase in the quantity demanded for a product would be associated with what? Increase in the price of a complementary product. Well, this is not true, because if the complementary product becomes expensive, like for example, if fuel becomes expensive, then the quantity demanded for the cars, which is a complementary good, will fall, not increase, cancelled. Increase in average household income. When the average household income increases, it will shift the demand curve outward, right? The demand curve is shifted to the right, or in other words called the increase in demand. But increase in quantity demanded is associated with price. So if the quantity demanded increases, it would have been caused by decrease in price. So that makes C to be the correct option. Okay, now this is an important question. The movement along the demand curve from one price quantity combination to another is called, now let's say this is your demand curve, and at this price P1, the quantity demanded is Q1. When the price is lowered to P2, the quantity demanded goes up. So these two combinations A and B, they are on the same curve. This is called movement along the demand curve from one price quantity P1, Q1 to another price quantity combination P2, Q2, right? This is called change in quantity demanded, C. What about option A, change in demand? Change in demand would mean the curve going outwards or inwards, sometimes called the shift in demand outwards, inward, or increase in demand. So change in demand, shift in demand, and increase in demand is reflected by the shifting of the demand curve itself. If a product has a price elasticity of demand 2.0, PED is greater than 1, it is called elastic, relatively elastic. So that would make C to be the correct option. So this is the situation. Conversely speaking, if PED is less than 1, it is said to be relatively inelastic. And then if PED is equal to 0, it is called perfectly inelastic. And if PED is infinity, it is called perfectly elastic. And corresponding curves would be this way: elastic, relatively inelastic, perfectly inelastic, and perfectly elastic. So now you know. In microeconomics, the distinguishing characteristic of the long run on the supply side is that only supply factors determine the price and output. This is incorrect because in the long run, all supply side inputs are variable. Only demand factors determine the price output. Wrong. Firms are not allowed to enter or exit the industry. That would be true in case of monopoly. This is the correct option. All inputs are variable. Remember, in microeconomic analysis, long run is a situation or a time frame where all supply side inputs are variable. Utility companies can generally price their products, a good that establishes a comfortable lifestyle like electricity, gas for home heating, based on the fact that the demand is relatively inelastic. Fuel, food items, utilities, electricity, gas, water, we need them. We have to have them even if they are priced higher. So that's why the demand for such services and goods is relatively inelastic. So that makes C to be the correct option. The competitive model of supply and demand predicts that a surplus can only arise if there is surplus, when the quantity supplied is more than the quantity demanded. So this is the equilibrium quantity. This is the equilibrium price. Now, if the price is set above the equilibrium, this is what you call the minimum price. When the minimum price is set above the equilibrium, at this price the quantity supplied is more, whereas the quantity demanded is less. Since quantity supplied is more than quantity demanded, this will result in a surplus. So that would make D to be the correct option, minimum price above the equilibrium price. Which of the following statement is true, assuming that the demand for a product is price unit elastic? When the price elasticity of demand is 1, in that case, if the price is increased or decreased, the total revenue stays the same. You need to remember that. So an increase in price will result in decline in total revenue. An increase in price will result in decline in quantity demanded. That is less than the increase in price, wrong. If the price goes up, quantity demanded falls proportionally. And if the price is decreased, the quantity demanded increases proportionally, resulting in the same total revenue, wrong. An increase in price will result in an increase in total revenue, wrong. An increase in price will have no effect on total revenue. That's exactly what I was saying. D is the right option. Which of the following pricing policies result in establishment of a price to external customers higher than the competitive price for a given industry? That would be collusive pricing. Collusive pricing occurs when the competing businesses collude, they become one, and then they set a price that is beneficial for all of them. So they will set a price that benefits them all. So the price set usually would be higher to external customers than the price in the competitive market. What about B? Dual pricing. Dual pricing, wrong. Dual pricing basically involves setting different prices of the same product in different market. Like for example, if we have a market A and B, we sell the item at 10 in market A and 12 in market B, same item sold differently in different market. That's dual pricing. Predatory pricing, on the other side, is a pricing strategy where the price is set so low, sometimes below cost, that it will kill your competitors and you may become the sole king of the market. So this is not what we are discussing here. Transfer pricing. Let's say you have 3 segments, X, Y, and Z. And these segments are, let's say, either investment centers or as profit centers. And whatever they produce, like input of Y is the output of X. And output of Z is the input of Y. So we might set certain prices for these items sold internally to within the same company's different segments. So transfer pricing occurs when the services and goods are sold within different segments of the same company. This is not what we are looking here. The impact of government price support program would most likely result in which of the following situations? Let us first see, this is the demand curve, this is the supply curve, SSDD, quantity and price. If the government gives subsidy, that means the suppliers can supply more, right? If this was the original quantity produced, now there will be more quantity. It would lead not to shortage, rather it would lead to surpluses. So that makes A to be the correct option. The city ordinance that freezes the rent prices, like rent controls, like rent stabilization measures in certain cities, metropolis like Dubai or London or New York. Now, let's say this is the supply of houses, apartments, and this is the demand, right? So this would be the equilibrium quantity, and this would be the equilibrium rent. Now the rent freeze would mean it is set below the equilibrium, right? At this point, the quantity demanded would be more than the quantity supplied, so there would be a shortage. There would be a shortage. The quantity demanded of rental space exceeds the quantity supplied. That makes C to be the correct option. If in a competitive market, a price ceiling is imposed, establishing a maximum price below the market equilibrium price, this price ceiling would, let us do what we have been doing. This is the supply curve, demand curve. This is the equilibrium quantity and price. And it says that the price has been set below the equilibrium as a maximum price. This would result in quantity demanded being more than the quantity supplied. Resultantly, there would be shortage. Shortages. We have done a question like this. Shortage because the quantity demanded would exceed the quantity supplied. A is the right answer. Straightforward. An investor has 200 in an FDIC insured money market account. FDIC stands for Federal Deposit Insurance Corporation. So it's an insurance on your deposits. Her financial advisor recommends that she takes half of the money and invest it in balanced mutual fund holding stocks and bonds. The biggest risk to the investor is not following her advisor's suggestion is this is incorrect. Liquidity of her funds, this is not an issue because the money market accounts are highly liquid. You can withdraw whenever you want. Potential loss of principal, impossible. This is an insured account, FDIC insured money market account. That is wrong. Taxes owed on investment gains, since it's a highly liquid money market account, the returns would be minimal and the taxes on them will be very small amount as well. So this is not true. Inflation eroding the value of her money. This is true. Inflation erodes the purchasing power of your monetary assets, and that's what her biggest trouble would be if she doesn't listen to her investor. A manufacturer performed an analysis of its product's price point in an effort to meet its customers' demand without experiencing excess inventory. Okay, now just look at this. These are the price points and supply. So if you just take these two, this is what you will get, a supply curve. And if we incorporate price and demand into it, it will become your demand curve. Okay, now the manufacturer uses just-in-time inventory processes and demands for product is elastic. Which of the following prices should management use in order to address the efforts above while maximizing profits? Hold what you can sell. Do not overstock and do not understock that your customers go empty-handed. So set a price at which the demand and quantity supplied are the same, right? So that would make C to be the correct option. The local video stores business increased by 12% after the movie theater raised their prices from $9.5 to $11. Since the price for the tickets in theaters has gone up, people will switch their demand to the local video stores, so their businesses went up. So why did it happen? Because the video stores business is substitute to the movie theater business. That would make A to be the correct option. A company increased the price of its products and noted subsequent decreases in demand as below. Product A increase in price was 20%, demand decreased 40%. If you calculate the price elasticity of demand by dividing the quantity with the change in price, it's going to be $2. So that is clearly greater than 1, so it is relatively elastic. For the second item B, 20 upon 30, the price elasticity of demand would be 0.667, which is clearly less than 1, so it is relatively inelastic. Now let's see what is the right option. The data above best support which of the following conclusions regarding the price elasticity of demand for the two products. A. Product A is treated by consumer as a necessity. Had it been a necessity, the PED would have been less than 1. Wrong. Product B is treated by consumer as a luxury item. Had it been a luxury, the PED for item B would have been greater than 1, which is incorrect. It is less than 1. Incorrect. What about C? Substitutes are more readily available for product A than product B. Product A has more substitutes, that's why its PED is greater than 1. Remember, whenever a product has a higher price elasticity of demand, that would mean that there are many substitutes for that product. So there are more substitutes for product A, that's why its PED is greater than 1. And there are less substitutes for product B, that's why its PED is less than 1. So look no further. This is your right option. And D is totally opposite to statement C. In a competitive market, an increase in the minimum wage, let's say if the current minimum wage, let's say just it's $1,000 per month, and now it is being revised upwards to $1,500 per month, will likely have which of the following effects? A. Firms currently paying above the new minimum wage, the firms are currently paying, let's say, $1,800, would generally raise their pay rates. Why would they? They are already paying more than the minimum wage. Why would they? Although the new minimum wage creates a new floor for the employees' wage bargaining, they won't. They are already paying more than the current minimum. They won't. Firms paying at the current minimum wage rate, $1,000, would generally be unaffected if the marginal revenue product by the lowest paid workers does not exceed the new higher cost of the workers. The firm that is currently paying $1,000, it will have to raise the price to $1,500, the wage to $1,500. So it will be affected, not unaffected. Not unaffected. And second part is also incorrect. The marginal revenue product of the lowest paid worker does not exceed the new higher cost. In order to make the new workers cost beneficial, the marginal revenue product must be more than the cost of hiring new worker. And right now, since it is at the lower end, it has to increase the minimum wage to $1,500, so it will be affected. C. Total employment will likely decrease. This is true. When the minimum wage rate is increased, the employment falls and it will generate unemployment. Yes, unemployment would increase. Employers will demand a smaller number of workers. Yes, while a large number of workers will be attracted by this new higher wage of $1,500. So this is the correct statement. What about D? If a marginally more expensive form of capital is available, marginally more expensive, to substitute for labor, the firms will reduce their use of labor. This is totally ridiculous option. Why would we replace labor to move to capital that is more expensive than the higher wage? If the correct option would have been, if a marginally less expensive form of capital, less than $1,500, is available to substitute for labor, firms will reduce their use of labor. So this is incorrect. Which one of the following changes will cause the demand curve for the gasoline to shift to the left? Let us see one by one. This is the demand curve as of this point in time. The price of gasoline increases. If the price of gasoline increases, you will demand less, so you would fall somewhere here from this position. So you will slide up the same curve. The demand curve would stay the same. It's just that the quantity demanded will fall with increase in price. So this is not correct. What about B? The supply of gasoline decreases. If the supply of gasoline right now it's at this point S and it falls to S1, your demand curve stays the same. It is still on the same position. It's just that the quantity demanded might be lower, but this would not shift the demand curve. So this is incorrect as well. The price of cars increases. Yes, when the price of cars increases, people will buy less cars, and less cars mean the demand curve will shift inward or shift to the left to new position D1. This is correct. And why not D? The price of cars decreases. When the price of cars decreases, that would have seen the increase in demand. The demand curve would shift outward or shift to the right. But this is not the case, because we have to show the shift to the left, and that is possible only in position in option C. Which of the following would cause the demand curve for a commodity to shift to the left? This is the demand curve of the commodity D1. We want to see the shift to the left in which of the situations? A rise in the price of a substitute product. If a substitute product becomes expensive, people will buy more of this product, so the demand curve will shift to the right, not left. So this is incorrect option. Okay, what about B? A rise in average household income. When the average household income rises, this item will be demanded more, so the demand curve will shift outwards in this case also. So this is again incorrect. We need to see the shift to the left, wrong. C, a rise in the price of a complementary goods. Let's say this represents the demand curve for fuel. Right? Now, and cars being the complementary to fuels. So if the car prices go up, resultantly people will demand less cars. Since they will demand less cars, so the demand for the fuel will decrease, and it will decrease or move to the inwards, or you would call shift to the left. That makes C to be the correct option. A rise in population would cause the demand curve to shift outwards, shift to the right, and this is incorrect also. If a group of consumers decide to boycott a particular product, they decide not to buy it, the expected result would be a pretty straightforward question: a decrease in the demand for the product. Now, why not A? An increase in the product price to make up the lost revenue. Already the demand is falling, so why would they raise the price? Incorrect. Increasing price will further decrease the quantity demanded because they are already being boycotted. An increase in the product supply because of increased availability. Wrong. Supply will be unaffected by the boycott. D. That the companies in the industry would experience higher economic profit. This is again wrong. A boycott of a particular product will reduce the overall profit for the industry, and of course specifically for that particular business or firm. In competitive markets, an increase in an effective minimum wage will have neutral effect on the demand for labor. Wrong. This is absolutely incorrect, because an increase in the minimum wage will decrease the demand for labor. Wrong. Decrease in the supply of labor. Wrong. The supply of labor will likely to go up when they see the wage rate has gone up. There will be more people willing to work. So increase in the supply of labor would be the right option. So I'm crossing it. C. Decrease in unemployment. Wrong. Since the minimum wage has gone up, supply of labor has gone up, many people will be there unemployed. So unemployment would increase, not decrease. Unemployment would increase. That makes D to be the correct option. In competitive markets, an increase in demand for a product causes increase in demand. Let's say this is the original demand curve, DD, and it goes up to new position D1, D1. And this was the original supply curve. Look at this, what has happened. This was the original equilibrium quantity and price, and now it has gone up. The equilibrium quantity has changed as well as the equilibrium price. So which of these is the right option then? Let's see one by one. Increase in product supply. Product supply has extended. Quantity supplied has extended because of increase in price. Incorrect. Reduction in the purchasing by consumer. Now there are more purchases. Wrong. Reduction in the number of buyers of the products. More buyers. Increase in the price of the product. Absolutely right. D is the right option. If the elasticity of demand for a normal good is estimated to be 1.5, then 10% reduction in its price would cause, we know the formula, price elasticity of demand is the percentage change in quantity demanded upon percentage change in price. PD is 1.5 and it says 10% reduction in price. So it will result in percentage increase in quantity demanded by 1.5 times 15%. So quantity demanded would go up by 15%. So that should make C to be the correct option. Quantity demanded to rise by 15%. Long Lake Golf Course has raised green fee for 9-hole game due to an increase in demand. Regular weekly, previously they were paying 10, now they will pay 11. Resultantly, the demand for this category has fallen from 80 to 70. Senior citizens previously were charged $6. Their new rate is $8, and this increase in price has caused a decrease in demand for this category from 150 to 82. Now, the weekenders, when the original rate was 15, revised to 20, so the demand, instead of falling, rose marginally. So apparently it's less elastic. Which of the following is correct? There are two ways you can do this question. The first is you can calculate the price elastic demand for each one separately. How you're going to do it? Calculate the percentage change in quantity demanded divided by the percentage change in price, and do this for all. So here I have calculated the price elastic demand for all these classifications. Change in price, 10% change in quantity demanded, 12.5. Similarly for senior citizens, 1.36, and weekenders are very less elastic. Okay, now it says the regular weekday and weekend demand is inelastic. Regular weekday is elastic and weekend is inelastic. So this is partly true. The regular weekday and weekend is elastic. Wrong. Weekend is inelastic, weekday is elastic. Incorrect combination. The senior citizens and weekend demand is inelastic. Weekend is inelastic, senior citizen is elastic. So this is again partly true. The senior citizen demand is elastic, true. And weekend demand is inelastic, true. D is the right option. So in this alternative method, what you can do is multiply the original price with the original quantity and calculate the total revenue. New rate versus new quantity, the new. So you can see here in this category, the regular weekdays, this was the original revenue. An increase in price has caused reduction in total revenue. So total revenue has fallen. So in this case, PED clearly is greater than 1 because demand is more responsive to price. An increase in price has resulted in decrease in total revenue. What about the second senior citizen category? Total revenue previously was 900. Now 8 times 82 is 656. So for this category, total revenue has fallen. So that means PED is greater than 1. Look at the last category. The previous revenue was 15 times 2 to 1, 3315. And now the revenue has gone up. So despite increase in price, the total revenue goes up. This happens when the price elasticity of demand is less than 1. More or less people see it as a necessity. Weekenders need to play golf, and that's the reason D is the right option even using this method. Wayman family typically ate hamburger as a regular staple in their diet. In the last few years, the family income has doubled, and they have now replaced hamburger with steak as a regular staple in their diet. Because of increase in their income, they have started consuming less of their previous staple meal, 8 hamburgers, less in quantity now. So this is an example of clearly the family has responded hamburger to be as if it's an inferior good. Increase in income has caused increase in steak and reduction in their regular hamburger meal. If a product's demand is elastic, PED is greater than 1, there is a decrease in price. Price decrease would result in more quantity demanded, and that would increase the total revenue. Decrease in total revenue, no change in total revenue. Look for the straight option. An increase in total revenue, D. A company currently sells 100 units of product A at $10 per unit. The company also sells 100,000 units of product B at the same price. The company raises the price of both products by 10%. Is it a wise move or not? Let's see and decide upon the elasticity. Product A has a price elasticity of 1.5 and product B has a price elasticity of 3. Amazing. Both of these items have price elasticity of demand greater than 1. So any increase in the price would cause the quantity demanded to fall and would cause the total revenue to fall. This is what we have been discussing so far. Company revenue will decrease for both products. That makes B to be the correct option. An increase in the price of crude oil will have what effect on the equilibrium price and quantity of gasoline? Since crude oil is the major input, so the increase in price of crude oil would cause the cost of production to go up. That will eventually raise the price of this item. So the price of the item would go up, and since the price is going up, the quantity demanded of gasoline will fall. So the combination that I'm looking for is B. Price will rise, yes, and the quantity demanded for gasoline will fall. That makes B to be the correct option. A company has a policy of frequently cutting prices to increase sales. Product demand is significantly elastic. We know PED is elastic. That means if the price is decreased by 10%, the quantity demanded would increase by more than 10%, maybe 30%. So then what we're looking for, quantity increases proportionally more than the price declines. Absolutely, look no further. This is the right option. If the demand for a normal good is inelastic, PED is less than 1, then the sales price of the product would increase following what? Decrease in the price of the substitute would cause the quantity demanded for this item to go up. We're talking about this normal good. Increase in the supply of the product. Increase in supply may result in decrease in price of this product. The decrease in the supply of the product, yes, this is opposite to option B and the right result, right option. Decrease in the supply of the product will increase the demand of, or increase the price of this product we're talking about. C is the right option. When the supply of and demand for a good both increase. Okay, now this is the supply and the demand curve, D, D, S, S. So that would mean this would be the equilibrium quantity and the original equilibrium price. If the demand increases to the new level D1, D1, at the same time, supply increases to the new level S1, S1, right? What happens? The quantity, equilibrium quantity is definitely going to be more. But what we are not certain about that the price might slightly go up or down, because we are not sure to what extent demand and supply have increased proportionally. So it could be up or down. So there would be some variation in price, but quantity demanded for sure increases. So what we can then say, equilibrium price may increase if the quantity demanded has increased more proportionally than the increase in supply, or it may decrease if it has increased less in proportion to supply, or remain unchanged if they move same in proportion to each other. So it can mean that either the price goes up or down or remain unchanged, but we are sure 100% that the quantity, equilibrium quantity, would increase. In any competitive market, an equal increase in both demand and supply can be expected to always increase market clearing quantity. So an increase in both demand and supply can be expected to always increase market clearing quantity. The equilibrium quantity would be higher if both demand and supply increase. A corporation recently issued 5 years debt with a coupon rate of 4.25%, payable on a semi-annual basis. Which statement is most accurate regarding the impact of inflation on this debt issuance? Interest outflows will increase each year due to rising prices. This is incorrect, because interest payments that do not depend upon the price level, it's a fixed payment based upon the coupon times the par value of the bond. Wrong. Interest outflows will decrease. They will neither increase or decrease with inflation. See, the real cost of principal owed at maturity is below its future value. This is absolutely right, because the real cost is equal to future value upon 1 plus inflation rate raised to the period n, the number of periods for maturity. So if you can just see, if you plug in the higher inflation rate, the real cost would be lower. So that makes C to be the correct option. As the price of a particular product changes, the quantity of the product demanded changes according to the following schedule. The price elasticity of demand for this product when the price decreases from 50 to 45. 50 to 45. Let us first calculate the percentage change in quantity demanded. That is 50 upon 100 into 100. So clearly it's 50%. And the percentage change in quantity in price, that is 5 upon 50 times 100. So that's going to be 10%. So the price elasticity demand is percentage change in quantity demanded upon percentage change in price. That is 5. It's quite a high number. So that would make D to be the correct option. Product demand increases and product supply decreases. Okay, now this is the original demand curve. This is the original supply curve, and that means this is the equilibrium quantity, QE and PE. Now, demand increases to a new level D1, D1, and supply decreases to S1, S1. So what you expect? Price to go up. Now regarding quantity, quantity demanded may increase, may decrease depending upon the relative shift in demand and supply curve. So we are not sure about the quantity, but we are absolutely 100% sure that the price will go up, and that makes D to be the correct option. A large domestic manufacturer produces all of its motors domestically and sells them internationally. The company's management team is in the process of developing its year 2 budget. Right now we're in year 1. And copper cost represents a significant line item in the budget. In year 1, the company spent $1 million in purchasing 250,000 pounds of copper. Economic data indicate that in year 1, copper cost had a price index of 120. Expectations are that the index will increase to 126 in year 2. Management anticipates 5% increase in copper usage for year 2. What amount represents the year 2 budget for the copper purchase? First of all, we need to see the price increase in copper. The index is going to go up to 126 from 120. So if you calculate the percentage change, it is going to be 5%. So it means the price will go up from 100 to 105, or what the current price is, 1 million upon 250. So the current price is $4. So it will go up by 5%. So the new price will be $4 into 1.05. The new price will be $4.2 per pound, right? So this will be the new price, and our usage will go up by 5% also. So from 250, 5% up means 250 pounds increased by 5%. The new quantity for the next period is going to be 262,500 to be acquired at 4.2. So the total cost will be 1.102,500. That would make C to be the correct option. In a competitive labor market, a minimum wage that is set above the equilibrium wage will result in which of the following? Minimum wage is above the equilibrium wage, so what will happen? Decrease in the quantity demanded for labor. This will surely happen. Since the wage rate is very attractive, increase in the quantity supplied of labor, more people will be willing to work, correct? See, a decrease in total employment. Since the wage rate is now high, the minimum wage is high, so the firms will cut on their workers. They will have fewer employees. This is true. A decrease in total employment. So in other words, we can say all of the above choices are correct. If a CPA's client expected a high inflation rate in the future, the CPA would suggest to the client which of the following types of investments? Common stock is a monetary asset. Its value will lose. Corporate bonds will lose. Treasury bonds will lose. Precious metals. This is the right option. It's a non-monetary asset, won't be affected by inflation. Suppose the equilibrium wage of low-skilled workers in California is $6 an hour. If the government increases the minimum wage to $7 an hour, what would be the effect on the market for low-skilled labor? So this can be done. Supply of labor. This is going to be the demand for labor, right? And let's say if this is the equilibrium quantity of labor and this is the current wage rate $6. If the minimum wage rate is set as $7, you can see the supply of labor is more than the demand for labor, so there will be excess supply of labor, so that should make B to be the correct option. Excess supply of labor would result. Diamond Company uses a material that cost $195 per ton at the beginning of this year and $200 per ton at the end of the year. The industry experienced 4% inflation during the year. What is the change in the real cost of diamond's material? Okay, now if $195 represents your cost at the beginning, because of inflation, it goes up to $2.5, $8, $2.8. But the cost at the end is basically $200 per ton, which means the real cost has fallen. An increase in the market supply of beef would result in, let us draw, this is the supply curve, this is the demand for beef. Okay, an increase in the market supply of beef. Now, this is S1, S1. Decrease in the quantity of beef demanded. In fact, there is an increase in quantity demanded from this point to this. Increase in the price of the beef. No, there would be decrease in the price of the beef. This was the first price, now this is the revised price. Decrease in the demand for beef. We have not been given any information regarding shift in demand curve, so we just cross this out. Increase in the quantity of beef demanded. Absolutely right. That makes D to be the correct option. A lender and borrower signed a contract for $1,000 loan for 1 year. The lender asked the borrower to pay 3% interest. Inflation occurred at the price and prices rose by 2% over the next year. The borrower repaid $130. What is the amount worth in real terms after inflation? So it's very straightforward. 130 divided by 1 plus inflation rate, which is 2%. If you simplify, the actual cost is $1,009.8. That makes D to be the correct option. When the demand for a product is inelastic, a decrease in price has what effect on the number of units sold and total revenue? We know if the price elasticity of demand is less than 1, a decrease in price will cause an increase in quantity demanded, and the quantity demanded would increase but less proportionally than the decrease in price. So resultantly the total revenue would decrease. So that makes A to be the correct option. The percentage change in price will be greater than the percentage change in quantity demanded, and the total revenue will fall as per this arrangement. An entity is examining potential investments and notes that 1 year maturity yields are higher than those of 10 years maturities. Which of the following explanations of this occurrence is best? A. The short-term investments have higher liquidity and therefore carry a high rate of interest. Incorrect. Investments with higher liquidity will carry lower rates of interest due to reduced risk, so this is an incorrect statement. B. The short-term investments carry a more immediate default risk premium, resulting in high rates of return. This is again incorrect because long-term investments, they carry higher default risk due to the number of payments and length is much longer. So this is incorrect. What about C? The long-term instruments provide a longer stream of investment income and therefore carry a low rate of return. This is again incorrect. Long-term instruments carry a high rate of return to compensate for high risk because of the overall long-term nature of the bond or the note. Then it has to be D then. Investors are expecting reduced inflation in the future as reflected in the lower long-term returns. This makes perfect sense and fully in reconciliation with the question information. The price elasticity of demand is 2.0 and the quantity demanded right now is 5,000. The price increases by 10%. The quantity demanded should fall by 20%. So 20% of 5,000 means 1,000. So quantity demanded now would be 5,000 less 1,000, 4,000. That makes B to be the correct option. How does inflation distort reported income? Wages are not reflective of current labor rates. This is not true. There is always an inflation premium added in the cost of labor. So this is not true. Sales are not reflective of current product prices. This is wrong also because product prices in a free market will increase with inflation. So sales revenue will reflect the inflation. This is incorrect. Depreciation is not reflective of current fixed asset replacement cost. This is absolutely right because depreciation is a systematic allocation of the depreciable base over the life of the asset. So not necessarily incorporating the effect of inflation. This is true. Why not D? Interest expense is not reflective of current borrowing rate. Again, this is wrong because interest rates include inflation premium. So this is again not a right option. An increase in the minimum wage will move employers down the labor demand curve, causing the quantity of labor demanded to fall. Increase in the minimum wage will move employers up, not down the labor demand curve. This is how it would be. Wage rate goes up, you will move from this position to this and demand less of labor. So this is incorrect and is likely to increase the supply of labor as more people will be willing to work for higher wages. This part of the statement is correct. More people will be willing to work for the higher wage, but the first part is wrong. Why? Because at higher wage rate, there is an increase in the quantity supplied of labor, not the supply of labor. So this part makes it incorrect, which means neither 1 nor 2 are correct.